This video is if you've ever been denied for a business loan and the reason felt super vague. You're not alone. Most owners think a denial happens because someone read their story and just didn't like it on a personal level. But that is not what usually happens. A lot of the time, your file never even makes it to real underwriting review. It gets filtered out early by automated screening. That screening looks for patterns and eligibility signals before a human underwriter ever opens your application in the first place. I've seen that stall otherwise strong businesses more times than I can count. So in this video, I'm going to show you how lenders actually evaluate a file and what it takes to build one that moves forward instead of getting quietly filtered out before it even gets the chance. The digital heartbeat. When a lender looks at your file, they start with quick indicators. They're basically asking, is this worth a deeper look? One of the first indicator is your SBSS score. That's the Small Business Scoring Service score. It's a blended score. It pulls from your personal credit and your business credit data. And lenders usually use it as an early risk screening, especially for SBA loans, which are some of the best loans on the market. The benchmarks can change over time, but the structure of the score has stayed pretty consistent. In recent years, a lot of SBA lenders have raised their SBSS benchmarks. The exact cutoff depends on the lender and the program, but the SBA minimum, as I'm making this video, is at 165, and some lenders even require higher. And this is common just to clear automated screenings for SBA 7A and a lot of conventional bank loans. If your score is below a lender's threshold, your application may not even advance to manual underwriting for conventional loans. Conventional loans are really hard to qualify for. And here's another big thing. This step in underwriting, the SBSS, it doesn't just take you into consideration either. It considers any owner with 20% or more in equity in the business. In a lot of cases, the lowest qualifying owner score has a real impact on how the whole file gets evaluated. So one partner's credit can drag the entire profile down in the application process. If you want the smoothest path, aim well above the minimum. A lot of the time that means trying to be in the 170 to 180 range because it reduces friction and improves your approval odds, the profit pulse. If you clear the automated screening, then the human underwriter matters a lot more. This is where cash flow becomes the backbone of the file. This is where they really start digging into your financials once you pass the initial screening. One of the first things they'll look at is your DSCR, your debt service coverage ratio. Most conventional lenders want to see that your business generates at least $1.25 in operating profit for every dollar of total debt payment. That extra margin is the cushion for conventional lenders. It protects the lender if revenue dips, expenses rise, or something unexpected happens. And as we move through 2026, lenders have gotten more serious about verification. Tax returns are often compared directly against bank statements. If things don't match, they ask questions. Clean financials matter more than ever. Strong files usually have organized accounting records with a CPA, often from softwares like QuickBooks, and they're getting their profit and loss and balance sheet or their financials every single month. They also show a real history of profitability or positive cash flow. Lenders really like to see positive increase in cash flow on a year-over-year or even a quarter-over-quarter basis as well. A lot of these lenders prefer 2 years of operating history to qualify you for conventional loans, but approvals can still happen with less when the rest of the file is extremely strong. Next, the operator behind the business. Here's another thing that people tend to miss. Banks don't just lend money to businesses and cash flowing companies. They lend money to people as well. So underwriting also is going to be evaluating the operator, especially if you're not an 8-figure business already. They want to see that you have a history of paying your bills on time. So they are going to either do a soft or a hard inquiry on your personal credit to make sure that you're not in a ton of debt or have a bunch of derogatories. Also, having experience in your field helps. The more time in business you have, the better your application is going to be and the stronger you're going to look to an underwriter. When time in business is short, lenders usually tighten the standards because companies with shorter time in business tend to be higher risk and can fail a lot easier than companies with a longer track record. Your personal equity. Another critical piece of certain programs is equity injection. This is your skin in the game. For most SBA financed acquisitions, startups, or commercial real estate loans, lenders are going to expect you to contribute at least 5 to 10% of the total loan amount. And then for other conventional and alternative loans like DSCR or conventional real estate loans, you're looking at anywhere from 15 to 30% down. Depending on the deal, the industry, and the overall risk profile, that number can even be higher. And lenders are usually going to want that equity to come from your own funds or acceptable documented sources with capital that is seasoned. Things like savings or asset sales. Borrowed money typically doesn't qualify, but there are workarounds if you can get creative like we do. The big idea is simple. Clear, sourced equity builds confidence. It shows commitment, and it tells the lender you're sharing the risk with them, not pushing it all on them. Changes in the SBA landscape in 2026. SBA rules evolve constantly, and recent changes have affected how some programs work. You don't need to memorize all of this, but you do need to know it exists, and standard operating procedures have changed before you apply. Some expedited SBA loan programs may now have lower maximum loan amounts. And if you need a larger loan, you should expect more documentation, a longer process, and to put something down. There have also been clarifications around ownership eligibility. For certain SBA-backed loans, citizenship or permanent residency requirements can apply. Any owners who meet equity thresholds have to be reviewed for eligibility. So with SBA loans specifically, make sure that every owner has a green card or citizenship if they own 20% or more before applying. Also, with these new standard operating procedures, SBA proceeds generally cannot be used to refinance merchant cash advances directly unless specific criteria are met. On the positive side, there are still incentives for certain industries. Domestic manufacturing businesses, for example, can benefit from SBA relief through at least September 2026. There's going to be a lot of excess capital going towards them, and this can reduce total borrowing costs. Bottom line is, you want to understand which rules apply to your situations before you submit a file. Your roadmap forward. Most business owners keep applying with the same file, and they hope for a different outcome. A better approach is knowing how lenders see your business before you submit anything. Below this video is a link to schedule a strategy session with my team. We'll look at your file using the same underwriting principles that lenders apply, and we'll give you a clear path of where you stand. Most rejections, like I've said, they're not personal failures. They're structural mismatches. And a lot of the time, once you know the gaps between underwriting and your file, they're fixable, usually within 30 to 120 days. Want to know if you get funding right now if you applied today? I made a whole video on this right here. Capital is still more available than ever, but it flows to businesses that prepare correctly.